This is the Savvy Investor radio show and podcast. For help with your retirement, schedule a 15-minute phone conversation with the team at ProStatus Financial Advisors today. Just call 866-597-1040 and at thesavvyinvestorradio.com.
So we all know our 401ks got cut in half in 2008. That was the market doing it to us. We don't want that to happen again. Then we read around things like Tony Robbins out there talking about 401k fees. And he said 1% more in fees can rob you of 10 years of retirement money. That's not good either. But this report says those two are pittance compared to what can happen to you in taxes. The biggest drain on your investment returns can be taxes. So, Mike, talk to me about that a little bit. I know you say it all the time. Taxes, taxes, taxes. You know it, but I don't think everybody else knows that could be the biggest drain on their retirement.
You know, it's interesting. Ryan and I, we started working together about 20 years ago. And I know when I first started radio back in the early 90s, it was one of those things that we were espousing the importance of tax planning since 1997, when I got in the actual investment side of the business, 1997. And I have been espouting the importance of tax planning for 28 years or whatever that works out to be. And over the last 5 to 7 years, we've seen all of a sudden a lot of people talking about it. And Ryan and I are actually, we're in a very unique situation with our practice. You know, we actually consult with about 20 other firms across the country. We work with a very, very large organization, and they ask us to come in and teach their thousands and thousands of advisors on the importance of tax planning, how to use tax planning, when to use tax planning. And it's incredible. I mean, at least these guys that are participating, they want to know more. Most advisors out there, the number one thing they do is they show you the statement that says, don't talk to us about taxes, right? Most advisors out there are working for a firm, and a lot of advisors are working for a firm that say, don't talk to me about taxes. I can't tell you how many people have come to work for us over the years that have no clue about the tax implications of the very advice they're giving. And to your point, people are acutely aware that, somebody charging 2, 3, 4% on investments, that's insane. 1 to 2% is kind of the normal range. And people understand that they have to pay attention to fees. Vanguard has grown this billion-dollar industry based around low fees. I get that part. But how about not losing 20, 30, 40% of your assets or your income each and every year to taxes? Why are you giving up 20 to 30, 40% of your legacy to taxes? It is such a simple thing to take care of. It is so well known that taxes are an issue. At the end of the day, you have a choice. You can take enough risk to create the income that you need so that you can give 20, 30, 40% to Uncle Sam, or you can take half the risk, not pay any taxes. And this is the crazy part. People don't understand. When they come in to sit down with Ryan and myself, we always have to explain to them that taxes are an option, right? You could opt in to paying taxes, or you can opt out. And that always begs the question, are you talking about, tax fraud? Everybody has to pay their fair share of taxes. That's a true statement. But just like all advisors will help you allocate your assets, right? We know if you go sit down with an advisor, that whole thing about modern portfolio theory, you diversify your investments along non-correlated asset classes, you'll increase your returns and decrease your risk. Everybody understands diversification. How come people don't have that same exact conversation about diversifying your tax bill? At the end of the day, there is a mathematical number. And you know what? I mean, it is such a simple number. For most people, having somewhere between $50,000-ish in savings and checking and brokerage accounts, something you're going to get a 1099 every year for, that's how much money you should have in there. No more. Not 100,000, not 300,000, not 500,000, 50 grand. You should have, as a single person, no more than about 150,000 in your IRA or 401k, whatever that deferred account is. And if you're married, filing joint, around 250,000 in deferred tax accounts. Everything else should be as tax efficient as possible. And tax efficient as possible means the 0% tax bracket. And you get to choose how to allocate your assets, right? It's not that you're forced to allocate your assets into the most taxed accounts you could possibly do it. It's that my whole industry isn't trained. They're specifically told, don't give tax advice. Well, how can you give an investment recommendation without understanding that the recommendation being made is going to result in losing 20, 30, 40%? And quite frankly, if you sat down with an advisor and that advisor told you up front, look, I'm charging you 1% in fees, and by the way, you're going to lose another 20 to 30% of your revenue every year to taxes. Do you like this idea? Who's going to volunteer to be that person? Who wants to be that person losing 20, 30% right off the top?
Here's Uncle Sam's plan. You want to follow that one? That seldom works. You want to use your plan? That's what we talk about at ProStatus Financial. Give us a call. Use our website. Let's talk about you and what you're in for to limit that tax liability in your retirement years. If you've saved $500,000 or more for retirement, this is where you'll see the power of tax planning really kick in. Go to our website, SavvyInvestorRadio.com. 2 V's in Savvy. SavvyInvestorRadio.com. There's a button there that says tax analysis. Start right there. If we've kind of got your interest peaked here and you wonder, what's my tax bill going to be in retirement? Let's figure out that number for you. Ryan, I was looking at one of those pie charts, and it had, where does the retiree's dollar go? And then, it had food, and it had gas, and it had utilities, and it had a little bit of travel in there. But 30 cents out of every dollar in a retiree's dollar goes to taxes. It could be property taxes, retail taxes, all sorts of. Now we're also talking about capital gains taxes, long-term, short-term, taxes on your 401k. It all gets different in retirement, doesn't it?
Yeah, I mean, and that's the one thing that unfortunately, like Mike said, most financial advisors out there don't talk about it, don't think about it, aren't allowed to do anything about it. And I feel that if your advisor isn't talking to you about taxes, you're doing a disservice to yourself, because everything that happens with your retirement, whether it's your pension, Social Security, your brokerage account, your IRA, your Roth IRA, everything that you do with your retirement funds and your income in retirement has a taxable consequence, and you need to be aware of it. There are all different types of stories that Mike and I can talk about when it comes to clients and taxes and things of that nature. But my absolute favorite story is, a number of years ago, and I'm talking 2014, maybe 2015. I had this couple come to me from a workshop. They came to see us. We were doing a dinner workshop down at a restaurant down in Crofton, Maryland. And they came to the workshop. They liked what Mike and I had to say. They came into the office. And what makes Mike and I unique is that I ask you to send us a bunch of information ahead of time. We ask for you to send us your account statements. I ask you to send copies of your estate plan and copies of your taxes. That way we can come up with, a tax plan. We can talk about fees. We can point out any things that you're missing. And I'm sitting down in my office before they come in, and I'm looking at their tax returns from 2014 to 2015. And I'm looking at something on this return, and I was thinking to myself, this has got to be a mistake. There's no way that this is actually what happened. And I went into Mike's office because I had been doing taxes at that point for about, 7 or 8 years. And I wanted to just make sure I was right in what I was seeing. Well, what happened with these clients is she was a doctor, and she had sold her medical practice in 2014. And she sold her medical practice for about $5.5 million. And when you sell something for that amount of money, you're going to pay a lot of money in taxes. You're going to pay a lot of money in federal taxes.
But I do want to point out, had she come to us ahead of time, we could have showed her how to not pay a bunch of taxes as well. But that's a different story. That's a different story.
Different story. And this was 2016, and I remember this now. This was 2016 that they came to see me. So I was looking at the past 2 years. They paid a lot of money in federal taxes, and they paid a lot of money in state taxes, which was, not out of the ordinary. And as I was walking through everything, I noticed that they had 2 separate financial advisors. When you think of wealth management, you think of these 2 companies. These are the 2 largest companies out there. They have their names on the side of buildings. They had 2 separate financial advisors, and I'm talking with the clients at this point, and I said, what happened when you sold the business? We said, well, we told them we sold the business. And our first advisor said, give me the money and I'll invest it. And they said they decided they wanted to diversify it between these 2 people. So they split the money up. Each one got, the better part of $2.5 million. And then I said, well, what about taxes? What did they talk to you about taxes? They said, well, nobody said anything to us about taxes, but our one financial advisor said, go talk to my CPA friend. We went and talked to the CPA, and he just said, yeah, you're going to owe a lot of money in taxes, make these estimated payments, and be done with it. So they sent off, I can't remember the number to the IRS, but they ended up sending off about $350,000 to the state of Maryland. Well, that was their only source of income. So 2014, they sold the practice. 2015, she was now retired. They were living off basically the cash that they had in the bank on everything that they had paid tax on. So they had no income. Well, back what tax law used to be at that point, everything that you had paid in state and local income taxes was deductible against next year's income, just like it is now, although it wasn't capped. And so what we saw on their tax return was a negative $350,000 because they had no income coming in and they had paid $350,000 of state taxes. Then a negative $350,000 that was there and just went away the very next year, and they started paying taxes again. And I sat down with them and I said, did the CPA not say anything to you about what you could have done here? And they said, no, they just said, send the taxes off. And then we went to do our taxes next year. We were just happy that we didn't have to pay anything after paying that huge amount the previous year. And what I pointed out to them was they had missed the opportunity. And this was not something that Mike and I could go back and change and fix or do anything like that. But they had missed the opportunity because they had zero income to take $350,000 out of their 401k, convert it to a Roth, and pay $0 in taxes. Because if we have a positive $350,000 on the tax return as far as the Roth conversion, and then that negative $350,000 deduction, that's a net zero on the tax return. So they could have done this massive, massive conversion without paying anything in income taxes. And the look of shock on their face was there for a minute, and then it switched to anger because they were working with not one, but two separate financial advisors who they told that they sold this practice and a tax person. None of the three of them thought about what can we do with this to help save them money in taxes.
And it was 5 minutes that you spent and figured out that savings?
Probably about 5 minutes, just from looking, just scrolling through the tax return, seeing that negative number and be like, wait a minute, something is wrong here. That is the importance, I think. It drives it home because I tell this story all the time. And the clients, they know who they are. They hear my story. They hear me tell it all the time on the radio, and they love it. You know, they don't love the fact that it happened, but they love the fact that I use it as an example. And if you want to find out how important tax planning can be for you in retirement and having an advisor who understands the tax ramifications, so you're not going to lose 30 to 40% of your money to taxes right off the top, I encourage you to give us a call at 866-597-1040, 866-597-1040. Sit down with Mike, myself, our team here at ProStatus, and we'll put together your very own tax analysis for retirement. You can call us at 866-597-1040, or if you're like me, go to the website, thesavvyinvestorradio.com. Right at the top of the page is a button that says schedule my call. You can schedule your meeting without ever having to pick up the phone. That is thesavvyinvestorradio.com.
That is all the time we have this week on the Savvy Investor Radio Show and Podcast. Guys, I'll give you the last word. Ryan, we'll start with you.
This is Ryan Herbert. Thank you so much for listening to the Savvy Investor Radio Show and Podcast.
This is Mike Canet. We'll see you, the Savvy Investor, next week.
Advisory services offered through ProStatus Financial Advisors Group, a registered investment advisor. Insurance licensed in Maryland. ProStatus Financial Advisors Group, LLC is not licensed in all 50 states. To find out if ProStatus Financial Advisors Group is licensed in your state, please call 410-863-1040. ProStatus Group, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through representatives of ProStatus Financial Advisors Group.